This signal rarely matters immediately, but when it does, it changes how fast the next phase arrives. And by the end of this episode, the tickers that feel it first will be clear. In our strategy, risk is tracked through a 5-phase cycle. Sequencing matters more than timing. Optionality matters more than conviction. This episode reviews a stock market report focused on rotation and volatility. The original creator walks through sector shifts and silver extremes. Our strategy translates those signals into phase pressure and probabilities. Markets are pressing higher, but leadership is not confirming. That tension is where risk quietly builds. The S&P continues to make higher highs. The Nasdaq does not clearly confirm. When leaders stop leading, fragility increases. This is where most people get misled. Divergences are not crash signals. They are early phase pressure signals. Materials, energy, industrials, and staples are leading. That is not random. That often appears late in the cycle. In our strategy, this rotation raises phase 2 probability modestly. It suggests compression risk, not immediate collapse. The window narrows, but it is not closed. Utility's relative strength begins to improve. Historically, that aligns with higher volatility sensitivity. It does not confirm stress, but it increases awareness. Hold this thought. Volatility regimes change before price regimes do. That matters for sequencing. When positioning shifts, dealers dampen moves less. Price action becomes jumpier. Small selling can travel faster. Our strategy does not predict the flip. It watches for persistence. Persistence compresses timelines. Silver is making extreme moves. Implied volatility is historically elevated. Distance from long-term averages is extreme. Silver often behaves like a stress amplifier. Not every spike means crisis, but extremes raise tail risk sensitivity. When silver massively outperforms gold, behavior is abnormal. It can reflect squeezes or panic hedging. Either way, it deserves monitoring. This is where it becomes actionable, not as a trade call, as a system stress input. Quick disclaimer, this is educational macro commentary, not financial advice. Breadth divergence and defensive rotation raise phase 2 pressure. Volatility regime shifts can compress timing. Phase 3 still requires credit confirmation. Before these signals, phase 2 risk sat in a moderate range. These inputs nudge that probability higher, not certain, but closer. This is still early. It is approaching a ladder watch zone. It is not a buy window. SPY and QQQ reflect leadership tension. SMH is the transmission node for concentration risk. XLU signals volatility sensitivity. Gold and silver act as stress thermometers. TLT is the first duration layer if yields roll. ZROZ activates only after confirmation. Exit discipline tightens. Position sizing becomes more conservative. New risk requires stronger confirmation. No phase jump on one signal. No all-in positioning. Credit and funding remain the gatekeepers. Which signal breaks first in your view? Breadth, credit, or volatility regime? We do not need to be early. We just cannot afford to be late.